Hey guys, welcome to the Age Exchange. It's good to be back and I've missed you. Now, I want to talk about inflation. Everyone knows about it. Everyone's seeing it in the supermarket and everywhere else. Now, I want to talk about why the market is still underestimating this thing. If you look over right there, you'll see the stock market has recovered over the last month or so. Now, I'm going to explain to you why that this is well and truly a bear market rally and it's built on false hope. In this video, I'm going to go through a number of scenarios. I'm going to look at the market, I'm going to look at the interest rates, I'm going to look at the inflation from multiple angles and how an economy actually reacts to interest rates and inflation, especially inflation that is sticky and hard to manage. I'm going to go through a couple of scenarios and look at the probabilities, and maybe towards the end, you'll come to the understanding that I have that we can probably not escape what's about to come. A deep recession and you could say a market crash. Let's see how it goes. Now, I want to talk about the recent news articles leaked articles from JP Morgan's CEO, Jamie Dimon. He actually told his clients that there's only a 10% chance of a soft landing, avoiding a recession, a 20 to 30% chance of a mild recession, 20-30% chance of a deep recession, and a 20 to 30% chance of something worse than a recession. In other words, a depression, or who knows how bad it could be, right? Now, what that means, if you do the math around that, so let's just skip the soft landing idea. That's out of the picture, right? It's 10%. Let's just, for simplicity's sake, it's out of the picture. He's saying that 20-30%, let's say it's about 30% chance that we'll have a mild one. 30% chance we'll have a deep recession, and then a 30% chance that we'll have something worse. Let's just go with the midway through that. Is that fair? So he's saying we're going to have a deep recession, right? This is the CEO of the biggest bank, maybe the most important bank in the world. And that's what he's saying to his private clients. We can probably take that not just with a grain of salt, but quite seriously. Now, in the meantime, they're telling their clients, hey, maybe we've reached peak hawkishness. Maybe we've reached peak inflation. Maybe inflation is slowing. And to be fair, inflation in certain areas of the economy is already starting to slow. And this is, I suppose, an effect of interest rates and other factors such as just people can't afford to buy as much stuff. Now, I have to also mention that oil prices have come back under $100, and in some areas, I suppose, food prices have seen some relief. Ukraine and the Russian conflicts, they've come into some truce where they can sort of export more food across the port. There's a truce in that area where they can export food from there. So that's really good for the world at large. But it still doesn't change a lot of the dynamics that we need to fight if we're talking about fighting inflation, right? Now, there's an assumption at the moment, since the last Federal Reserve meeting a month ago, that we're actually going to be more dovish. There's going to be a pivot where the central banks, or at least the Federal Reserve, is willing to cut interest rates and stimulate the economy in case anything goes wrong. Now, I believe when we look at how deep this inflation is, this idea that we can just take down the interest rates right away, cut interest rates, stimulate the economy, because once it goes off, once we have a recession, we need to save it. I mean, I don't think, when we look at how deep the recession is, I don't think that's a real viable option. Inflation is political. It's a political albatross. It's impossible to overestimate the political effects when people's earning capacity feels like it's dropping at 7-8%, just like that. Everything's going up in price, and people can't afford on their own current jobs to just have the standard of living that they were experiencing. It's politically unacceptable. We also have not a recession. We have an election, the midterm elections in the US coming up in November. That's only 2 or 3 months away, right? So inflation is going to be an issue that we're still going to be focused on tackling. There's no way we're going to be dovish anytime soon. And when we compare it to the 1970s, in some ways, our inflation is higher and worse than the 1970s. And if you look at the inflation numbers across the world, UK is experiencing double-digit levels of inflation. It's over 10%. Germany, they just had the producer price index come out for the year. That's over 30% increase. That's 30% increase in raw materials, in the price of raw materials in aggregate. So we're looking at some crazy levels of inflation. And if we think, the Federal Reserve and other central banks are going to lift to, maybe 3 or 4%, and that should handle it, I don't really know. When we have some levels of inflation reaching 30% in the developed world, right? Over 10% in the UK alone. And with the withdrawals of natural gas and oil and that sort of those energy resources from the Russian conflict, we don't know how much worse it could be. Saudi Arabia, yes, has pledged to, supply more oil, but what's the limits of that, right? And then you add into the fact the supply chain issues are still not resolved. China is experiencing power cuts in certain regions of the country, in Sichuan, right? And still has a COVID-0 policy, which means that anyone that's in contact with someone that's got COVID has to isolate. Businesses have to just stop operating if there's COVID cases to a certain degree. Right? It's not particularly functional, and they are the factory of the world. So if you add that up, as a manufacturing, we're not going to have the level of supply. Energy is still going to be elevated. Then this idea that just increasing interest rates is going to slow inflation, it's going to crash the economy, and then inflation is just going to slow is not necessarily true. Inflation through energy and food is still going to be elevated. And we add into the fact that, it takes time. It takes time to fix this inflation. And if you really consider, I just want to invite you to think about how feasible the Federal Reserve or central bank is to say, let's cut interest rates when there's still high levels of inflation. Like how possible is it? Like how likely is that? This idea that, the moment we have some sort of downturn, we're going to get a pivot and we're going to save the economy. I don't think so. I think, if you look at the Federal Reserve right now, all the doves, all the people that used to be like, let's stimulate the economy, let's print money and let's cut interest rates. Like Neil Kaskari, who's the ultimate dove, even he's saying that we need interest rates high. We need to take down inflation. So there's no one else in the Federal Reserve that is willing to think about pivoting, right? The true mood of the Federal Reserve has completely changed from what they did in 2020 and 2021 to fix and save the economy from the lockdowns. Now they've done completely 180. In recent meetings, Jay Powell actually says he didn't want to be the second coming of Arthur Burns, who was the guy before Paul Volcker, who lifted interest rates to 15% plus to take down inflation. This was the guy before him in the 70s who let inflation run hot and basically did so much economic damage that we need to have the next guy lift interest rates to absurd levels, 15, 20%, to calm down inflation and to fix the economy. Now, consider this. How would the world be if we couldn't handle inflation this time? That maybe 3-4% wasn't enough. Maybe we had to go 18%, right? 20% like last time. What would the world look like? What would the world look like if we could not get a handle on inflation even with high interest rates? Is it reasonable to assume that we just cut interest rates even if there was a recession? I think we might not cut the interest rates as soon as we think. I think we can keep the interest rates higher than we expected and we suffer the recession instead. I think that's entirely possible, right? So this idea that the market is elevated like it is right there, it is starting to drop. And I think it's relatively timely. I've already shorted the markets. I have, as you probably know, I'm a big trader, a bit less now. And I'm thinking about developing a course, but that's another story altogether. Now, we see that it's hitting the 200 moving average. It's well elevated relative to recent levels. So it's overbought, put simply. The market is primed to crash and take this down. How do I say this? In the last month, if you watch the headlines, everything was positive. Well, there's dovish. Oh, there could be the pivot. Everyone's saying there's a pivot. You watch, Bloomberg or CNBC, people say, oh, maybe it's over, right? And the market goes up, right? Who do you think that is doing that? The people that bought at the lows right there are telling their friends at CNBC and Bloomberg, hey, let's push it up and say everything's going to be A-OK. And now they've already sold at 200 moving average because that's where all the bankers, they all think that's a good place to sell, right? They're all reading each other's minds or having secret phone calls to each other, who knows, right? And now they're out of positions and they're calling the mates up at Bloomberg and CNBC to put more negative articles out. And you can bet your bottom dollar, more negative articles are going to come out. And you maybe say, the video I'm making right now is going to feel pretty timely. But this is how the market works. It goes up, it goes down. The rich people, they coordinate, I suppose, and they make out like bandits. This is just my warning to you guys, to just be really careful and consider this idea that, everything's hunky-dory, that we're going to do another GameStop or, Bed Bath & Beyond, and we're going to go to the moon and you can go into crypto and it's going to work out. Maybe not. Now, I want to finish with a final thought for why I think we can't escape this. Now, I've sort of recently explained I'm really into housing and property these days, and I've always been, but I truly believe that housing is the indicator that will truly dictate, how deep the recession goes. Housing itself has always led basically any major economy either into recession or out of recession. You look at 2008, housing crashed first, and then when housing started to recover, the economy started to recover. We're talking about at least 6-month lag. The economy itself follows housing. Now, housing is actually only starting to experience the pain. In the US, in Australia, in New Zealand, they're the first off the block. They've already dropped like 10% across the country. But what you see with housing is that when people start struggling to pay their loans, they have to get out of the houses. Housing prices, as they drop, less servicing. As housing goes, people are not spending money on furniture, on, tradespeople, on construction. It's a huge part of the economy. When that slows from high interest rates, there's not much you can do to fix that right away. It's a slow moving, vehicle, right? It's gonna keep going. It's gonna keep dropping. So even if we cut interest rates right away, you're still gonna get people suffering in the housing market. It takes time. Now, here's my thesis on how to play it. Yes, you can say there's at least a 6-month lag for what happens in the housing market to what truly happens in the real economy. And when the housing recovers, and then the economy truly recovers. But if you consider what happened with the March 2009 recovery in the stock market, that happened well before the economy started to recover. Actually, the US is really in the recession back in 2009, not 2008. 2008 was when all the market went crazy and dropped and, with the Lehman Brothers thing. But the recession that hit everyone was actually in 2009. And it was only somewhere around late 2010, maybe 2011, where it started to feel like a recovery. But if you look at the stock market charts, the low was in 2009, March 2009, where the market already realized, hey, we have a pivot. I don't believe that pivot is now for our current market yet. Maybe towards the end of this year or early next year, we'll have a pivot. But the recession is going to happen in 2023 and going forward. What that means is that the market, if you're trying to catch that falling knife, if you're trying to buy the lows of the market, I believe it's relatively difficult to do that because you got no idea when the market participants, the bankers, they just go, it's time, bang. And it's really easy to flood the market with cash and bid everything up super quick. As we saw probably in 2020, around there. How quick is that? It just went right away. Now, if you're trying to make money from recession, it sounds bad, but you're competing with mums and dads and families and real people that are struggling to pay their mortgage. If you have the cash on hand, you have anywhere up to a year to buy property on the cheap. Not this quick, boom, right away, in a matter of days. That's your opportunity. So that's my plan on how to best manage and take advantage perhaps of the situation I believe is coming up. I don't believe that we can get a pivot that will save us right away. I think the damage is already done. The housing market is already dropping, experiencing hardship from the interest rates increases. There is no way we're going to escape a recession. And there is no way that even with a quick pivot, that housing market is going to go like that. The housing market is going to stay depressed and then take its time going back up. You follow the housing market and you may just grab a bargain. You follow the stock market and it's going to constantly tell you on Bloomberg and CNBC, hey, we got to pivot. We're going to reduce interest rates. Boom. And I haven't even talked about quantitative tightening, which the Federal Reserve has not hinted that they're going to stop. So they've said that they might slow down the rate hikes, but they've never said they're going to slow down the quantitative tightening, which is the equivalent of taking money out of the economy to slow down inflation. That's still happening too. So for all these reasons, I've just stated, I think that a deep recession is probably inevitable, especially for the US, but that's replicated throughout multiple economies. And you can look across the world, and I can quickly show you a quick graph of inflation across the world. We're talking double-digit inflation, and that is just a big problem globally, not just the US. It's not that easy to fix inflation. I can tell you that. You look at the 70s, it took 10 years to fix it. Now, I hope you got a lot of value out of this video. I haven't done it in a while, so I may be a bit rusty. And if you liked it, you want to share it with friends, I encourage that. If you like it, please like it. And if this is your first time here or haven't been here for a while, consider subscribing. It really helps support my channel and supports what I do. I try to have a different angle to other finance YouTube people. And sometimes I delve into geopolitics and stuff like that. But yeah, please hit the like button. That'll be really appreciated. And I look forward to seeing you in the next one. share. And thank you. See you then. Bye.